Blake Bos here, folks. Today we're going to be looking at 5 companies with some rather large pensions that could be set to fall here soon. Number 1, we're going to look at LSI Corp. That's a semiconductor company. Almost 50% of its total liabilities are pension related. Then number 2, we have U.S. Steel Corp. This is a steel mill, very big. 36% of its total liability is in pension obligations. Number 3, Xerox Corp, tech company known for its printing solutions. 21% of its total liability is in pension obligations. Number 4, Caterpillar, heavy machinery company. 15% of total liabilities are held in pension obligations. And number 5, last but not least, Ford Motor Company, the popular auto company, 12% of total liabilities are held in pension obligations. And we're going to use Ford as an example to show what these pension obligations mean to the company. So Ford contributed $3.4 billion in cash to its pension obligations in 2012. That's half of the last 12 months capital expenditures for the company. So as you can see, this isn't small potatoes. This is a lot of money we're talking about here. And put this in perspective, a 1% increase in interest rates decreases pension expense by $600 million. That's a huge amount. But a 1% decrease in expected return on plan asset also increases pension expense by $600 million. So as you can see, it's not entirely clear what will happen with these plans, but as long as expected return on assets remains the same, things should be looking very good for these companies I highlighted above with rising interest rates. When we look at Ford, 2012 had $965 million in expense from amortizing losses on pension obligations. So what happens is these companies build up these losses and they write those off over time in smaller chunks. That's that $965 million. So 62% of pension expense is from this. This won't disappear entirely, but should decrease with higher interest rates and gains on the pension benefit obligation. So the takeaway here, folks, is this means that if interest rates continue to go up, and remember 10-year rates are up 47% year to date, that's nearly 1 percentage point. So pension expense should decrease along with cash contributions. As you can see with the Ford example, this isn't a small amount of money and frees up a lot of capital to be used elsewhere in the company. Also, be sure to keep in mind that increasing rates are good, but you also need that expected return on plan assets to remain the same and not decrease to get the full effect of rising interest rates on these pension plans. The ideal scenario is you get earnings per share expansion due to lower pension expense at the company, therefore a higher share price due to increased company profitability. So be sure to keep an eye on these pension plans as these companies report earnings that could be a nice upside that investors aren't entirely aware of. That's all I have for you today, folks. Be sure to keep an open mind in investing. Thanks for watching, and Fool on.